Hello everyone. Today I'm going to present Finance for Non-Finance Professionals Part 4 on my channel Financial Reality. If you want to develop the understanding of the topic, please do review my video till end. Further, if you are interested to have more and more videos on banking and finance related topics, please do subscribe my channel, that is Financial Reality. In this section, we are going to discuss the key ratios: liquidity ratio, cash conversion cycle, and operating cycle. Four categories of key financial ratio. First of all, liquidity ratio measure a firm's ability to meet cash needs as they arise. Second one is activity ratios, measure the liquidity of specific assets and efficiency of managing assets. Leverage ratios measure the extent of a firm's financing with debt, that is the part of the borrowings, related to equity. Equity is owner's contribution and its ability to cover the interest and other fixed charges. Profitability ratios measure the overall performance of a firm and its efficiency in managing assets, liabilities, and equity. We are going to discuss one by one all these categories of the ratios. First of all, here we have the balance sheet. Balance sheet is divided in three parts: assets, that is equal to liability plus equity. Here we have the detail of assets. Assets are divided in two key parts. One is the current asset. CA represent for current asset, and others are non-current assets. Current assets include like cash, account receivable, inventory. So it includes a number of more variables because it's the introductory section for the non-professional people. That's why I try to make it in a simplest form. Other I include the non-current assets, that include fixed assets, any long-term investment, etc. The size of the balance sheet is also called as total assets. Other part is liabilities plus equity. Liabilities include current liabilities. CL represents current liabilities, and second part is total equity. Current liabilities include all type of payables. Notes payables are short-term liabilities. Here we can also have short-term loans or the current portion of long-term loans. Accruals, we make the accruals against the expenses. Like you used to pay the salary on the 10th of the following month. So you will accrue salary as an expense for the month end. Long-term debt, it's a part of long-term borrowings. Common stocks, retained earning is a part of profit that is reinvested within the business. So you can compare total long-term liabilities plus equity is equal to asset. Second type of financial is income statement that include, first of all, sales or revenue. Secondly, cost of goods sold that include the raw material and other production related expenses. Other expenses. So EBITDA, earning before interest, tax, and depreciation and amortization. The figure of depreciation and amortization is given here. So we have EBIT, earning before interest and tax. Thereafter, interest expense, It is also used as financial charges. In some income statement, you will find the word instead of interest expense, that is financial charges. EBT is earning before tax, and thereafter you have the net income. In this case, the company having the loss, that's why the net income is negative. Liquidity ratios for the year end 2022. Current ratio is equal to current asset is to current liability. It should be more than 1. And here we have 1.17. Current ratio basically represents the ability to meet current liabilities from current assets. But further question arises that what should be the actual requirement for the business? That is clarified from the quick or the asset test ratio. Asset test ratio equals to current assets minus inventory, because inventory is the requirement for the business to meet production needs. Inventory is divided in 3 parts: raw material, work in process. Work in process means the time in which raw material is converted into finished goods. And third one is the finished goods. So these 3 are the part of inventory. I am going to repeat again. Inventory includes, first of all, raw material, then work in process. Work in process is the period in which raw material is converted into finished goods. And third one, finished goods, unsold finished good is also a part of current inventories. So here the value is 0.38. It means net of inventories, company is not able to meet the current liabilities. In other words, we can say the company do not having the ability net of inventory to meet current liabilities requirements. It may be because of the losses. Average collection period or day sales outstanding. That is equal to average account receivable. You will have the average of previous year ending balance, that comes current year opening balance plus current year's ending balance average, divided by average sales. Average sales mean total sales divided by 365 days. Average sales mean total sales divided by 365 days. That is the days within a year. So average account receivable will be divided by average sales. It is equal to 29.74, about 30 days. The sales, all the credit sales of the company are for the period of 30 days. Or in other words, you receive the amount against credit sales within 30 days. Days inventory held, average inventory, again, previous year's ending balance, that comes current year's opening balance plus current year's ending balance average, divided by average daily cost of goods sold. So here you will divide cost of goods sold by 365 days. Average inventory divided by average cost of goods sold. So it comes 66 days. It means a company holds its inventory for 66 days. It depends. Sometimes they need to hold for a more period. Sometimes they need to hold for less period. We have an example of Japan. In Japan, they have zero inventory system. Raw material directly comes to the production room. and it converted into finished good, and from their warehouse or from their production room directly supplied to the vendors. Days payable outstanding. Payables are against the purchases. Purchases are against raw material. Average accounts payable, again, ending balance of previous year, that comes opening balance for the current year divided by present year's ending balance average. Every day cost of goods sold, it means cost of goods sold will be divided by 365 days. So here payable period is 22 days. It means whatever you are purchasing on credit, you used to make the payment within 22 days. Cash conversion cycle. How many days a company take to convert the cash it spent on inventory back into cash by selling the product? It's very important. Cash conversion cycle also represents working capital or cash need. Cash conversion cycle is equal to day inventory outstanding plus day sales outstanding minus day payables outstanding. So we have inventory outstanding period is 66 days, sales outstanding period is 30 days, and days payable outstanding is 22 days. It means company takes 74 days to have cash back after the sale of the product. So you need working capital or the cash need at least for 74 days. So it is very important for the business to assess the cash need for the smooth flow of your production and thereafter sales. Other is the operating cycle. They are required for a business to receive inventory, sell inventory, and collect the cash from the sale. Yes. On the safer side, we use the operating cycle. That is equal to days inventory outstanding plus days sales outstanding. It is 66.11 and 29.74. So it comes about 99 days. It means on a safer side, you should have cash or the working capital to meet the production need for at least 99 days. Thank you very much. See you again with the upcoming video on finance for non-finance professions. Again, if you want to have more videos on banking and finance related topics, please do subscribe my channel. Thank you very much.